Good day, entrepreneurs. Today we're going to cover the management of cash flow. And in that detail, we're going to look at what are the things that we need to watch for to manage the cash flow, but also work through the items that we need to fix when certain things are not going right. One thing that you should remember, in the previous recording that we have done, we had indicated that cash flow is made of three things. Cash flow is the money that is sitting in your bank account, that is liquid, that is available for you to transfer and pay whatever. But money also is sitting too with your customers that actually you have sold to. And number three, money is also sitting with the suppliers that you intend to actually pay or that you actually have procured from. So in those three areas, we're going to look in more detail on how to make sure that you are managing cash flow properly. But we'll also cover the areas where most entrepreneurs struggle and come up with strategies and plan on how you can actually improve your cash flow. In that discussion, we will also cover something which is called cash flow projection and cash flow statement. The difference between the two is that one, the cash flow projection look at what has happened in future, whereas the cash flow statement is the part of the financial statement when you're actually receiving balance sheet and income statement, and there's a document which is called cash flow statement. Cash flow statement is recording the past, is the movement between your balance sheet and also your income statement. And now we're going to move to the board. As I said earlier, we're going to look at the cash flow. We're going to see how we should be managing the cash flow and the step-by-step of what needs to be in place for you to really master this. I'm going to start with the basic principle of what is cash flow and how we should actually be approaching cash flow. And I'm going to go to the board. The first part we're going to look at on cash flow is firstly understanding that the money is coming from customers. And the money is also coming from suppliers. The customers are paying you according to your terms and conditions. So we have to look at your terms and conditions. Your terms and conditions will be reported and enforced by your books when you are talking about your age analysis. Now, let me go a little bit more in detail. When you're selling to your customers, you're going to have standard agreement, which we call it terms and conditions. Under terms and conditions, you will state something like the customer needs to pay you within maybe 30 days, or they will pay you in 90 days. When they are paying, they will then be complying with the terms of conditions. And in your reporting, you will start monitoring if they are complying with the terms of conditions by you analyzing. And the age analysis is when you are issuing the statement that will show who has paid you, who has current account, who has 30 days, who has 60 days, who is sitting on 90 days, who is sitting on anything above 120 days. Now, in your business, we will then need to understand that the age analysis is telling you, is your customer complying with your terms and conditions? And if they're not complying with the terms and conditions, you then need to make sure that you have systems, which is number 3, of how you will actually now enforce the terms and conditions. Now, most cases as entrepreneurs, we are so hungry that we can't enforce the terms of conditions, or maybe we have very few clients. You're thinking, I would rather get a little bit than actually enforcing the terms and conditions, indicating that you cannot actually, feeling intimidated that you cannot hand them over to actually for debt collection. And that is where most problems usually start, because it then means you're not going to have the money during the time you had initially planned for. So the areas that you need to watch for first is to make sure that for your agreements there is terms and conditions. Number two is to make sure that you are actually monitoring the age analysis so that you see who actually is not complying. And you also, number three, work on enforcing the terms and conditions. That is what we call collection. That is what we also call debtors management, or should I say managing of customer collection. In these three steps, you will also need to keep in mind that when you set the terms and conditions, such must also be including a limit. For example, if the customer is currently sitting on 120 days and you have given them 30 and they've passed all of this, you should have a certain limit that you are not willing to give them in any way as a credit. So this is also important because as you review your age analysis, you should keep in mind the risk associated with keeping customers in this level. If maybe your books are saying that you're supposed to be paid on current or on 30 days. The other thing that also you will need to make sure you do is to categorize your customers based on the risk associated with the customers. So in your books, you can have customer A and customer B. So maybe on customer A, you know these are the ones that maybe you're gonna need to look at every week. And then maybe customer B, these are good ones, maybe you're only gonna look on monthly basis. So that it helps you to draw the reports and analyze. You know that B is a lower risk, but A is a higher risk, and those are the ones that you're gonna pay attention to. You might also need to think about maybe considering when you bring a customer on board on saying that maybe when you are starting, we have not established the relationship, pay me maybe 50%. That does reduce the risk, the credit risk that you are exposed to. So that will be the main step on customers. Within customers, you have these three steps, and also just remember to make sure that you're categorizing them, but these steps will apply to both of them. Now, I'm gonna come back to the suppliers. With suppliers, you will also do the same. However, in suppliers, you will not care much about the limit because the risk there, the credit risk, is with the supplier, not with you. So same principle, you are going to need to analyze and know what your terms and conditions with the supplier. Number two, you will also look at the age analysis with the supplier to check how quick are you able to pay the supplier. Here is receipting, here is payment. So here is payment, here is receipting. So again, your accounting records should be showing how much is sitting on current, how much is sitting on 30 days, how much is sitting on 60 days, and how much is sitting on 90 or more than that. It's the same principle. You also might need to categorize your suppliers. Maybe you might look at your suppliers in terms of raw materials, and you might say maybe consumables, and you might have other suppliers. The reason why you would like to actually categorize them like this, it allows you to be able to see and make sure that these two are always taking priority when you're doing your payment. Because if they are not taken, you might find that they are sitting in here and they reduce your limit, your credit limit, and you end up not able to produce. Enforcement will not necessarily apply when it actually comes to the supplier, but what you need to have is management of the supply. What do I mean when I say management of the supply? is where you go to the supplier and say, I have been paying you within the terms and conditions. Would you please increase my credit limit? These are the projections that I intend to actually be expanding in the next 6 months or 12 months. Please increase my credit limit. And if you need any additional information, let me know. In most cases, the suppliers will ask for financial statements. They will also ask for your bank statement for at least for 3 months so that they can see that the business is actually active. Be mindful, in other instances, the suppliers might actually even ask for management accounts. I will also show you how the management accounts should be set up. The purpose of this is to allow the supplier to assess the credit that they are exposing themselves to. Remember, when they give you the goods or whatever that you have purchased from them, they're giving you on credit. They therefore need to be able to know that they can recover that money. Those are the basic steps on how you should be looking at cash flow. That is the principle of cash flow and the management of cash flow. Now, as you're building up your business, when you are being asked to now prepare a cash flow projections, the same principle will actually apply. The same principle will apply. You will start by listing all the customers that you are expecting to actually be paying you. And I will just remove this so that we will then do the cash flow projection. So you will start with the listing of the supply of the customers that actually are your routine customers, to be able to know who is actually going to be paying. So step number 1 will be customer A. Let's say customer A, or I shouldn't use A because Arnold. Right? 2, Lamini. That's another customer. 3, company X. So that's a list of your customers. And then in your workings, you will then look at your financial period or the period that you are looking at, depending on what the projections that you are making. But in generally, you will put this according to a month. So maybe let's just say you're starting from July, August, September, and October. Those are the months you are preparing the cash flow projections. We say Arnold has bought items from me, and Arnold, according to age analysis of Arnold, he pays me after 30 days. When did Arnold buy? Maybe he bought in May. So which means you are more likely to receive your money in June. So Arnold, yes, I'm going to receive 30 Rand maybe. Lamini takes too long. He pays after 60 days. Then you plug in Lamini 70 Rand because he takes longer. You use your age analysis. Your age analysis is the one that gives you the trend. The trend of how that customer pays. You use that trend to inform you on who needs to be plugged where in your terms and conditions in the projections, cash flow projection. Company X, they usually pay within maybe 60 days. So 60 days that if they bought the items in May, all this customer bought in May, and this one pays within 30 days, this one pays 60 days. But maybe customer X pays after 120 and they owe maybe 130 Rand. Obviously, that will mean that That is now you will recover on 120, this is on 90, this is on 60, this is on 30. So that is why it's important to understand and analyze your age analysis, because what it does, it tells you about the trend, the payment trends of your customers, for you to be able then to plug in what should I expect to be paid. Please note that the sale has already happened here. These are not projections. This is not a sales projection. This is a receipt projections. Whereas a sales projection, you will have a different plan. It's also going to be informed by your promotion. It's also going to be informed by your plans in your marketing. And obviously, your conversion rates will also apply in that instance. So, but for this, we're only looking at the cash flow projection. And in this case, we're looking at the receipting. When do I expect to receive the money? You don't use your terms and conditions, but you use the trends that you have noticed, because the trends is also informed by taking into account the economic conditions. Whereas the terms and conditions may not have taken into account those things. And it's the same principle you're going to apply when you are now doing the payment arrangement. You will do the same thing. Supplier number, supplier Arnold, Mkhize. These are all the suppliers that you buy from, your raw materials, your other items and consumables. You will do the same thing. You will check how long, what terms have they given me, how am I paying, and then you plug in the payments. And obviously, because we're doing a cash flow projections, we're always gonna start with how much we're sitting with in our bank account as our opening balance. So we say opening balance, add the receipt less payments. And if we have a negative, then that is where we are in trouble with our cash flow. So we say we start with what we have, which is our opening balance. And then we say plus the cash receipts minus the suppliers. Then we're left with what? Your closing balance, which must talk to your bank account. That will then lead to your closing balance. And entrepreneurs, that is the management of your cash flow. Let me just run it down for you. First, it means that you're gonna need to have the books that are kept up to date for you to manage your cash flow. Number two, you're gonna need to know what are the terms and conditions that you have given your customers, and what are the terms and conditions that the suppliers have given you as the scope of how much you can buy from them, i.e. including your credit limit. And when should you be paying them? Other suppliers will say pay within 15 days, others will say cash on delivery, others will say 30 days is fine. You also need to make sure that you live by those. The next step is to look at, okay, these are the terms and conditions. I've plugged them in my system. I'm issuing the invoice to my customers, and organizing yourself and making sure that those books are kept up to date also means you're sending statement every month to the customers, and you talk to your suppliers when you're unable to pay. But in addition to that, you make sure that you monitor the age analysis. The age analysis gives you the trends of the receipting that you are actually getting from your customers. But on the supplier side, it tells you how quick or slow are you paying your suppliers. It's important to monitor those two things because they help you to see and monitor to make sure that you're actually making the right decision at the right time. It's very important, entrepreneurs, that you monitor that on monthly basis and also on weekly basis. The rule is you do not pay your suppliers unless the account is due. You also do not leave your books unmonitored in terms of customers that are actually not paying. You need to pick up the phone and call the customers and collect, which means you must have some policies and procedures on the debt collection. You must also make sure there is a clear control on managing the credit limit so that it minimizes the credit risk exposure that your business will be exposed to. Understand, when you are analyzing your business and you are applying for funding, these are the areas that we look at. We will ask you for the financial statements, but within that, we'll say, provide us with your risk and management account with the age analysis for both your suppliers and also for your creditors and also the customers. The purpose of this is to make sure that you are actually managing the cash flow, because the only way to manage the cash flow is managing that age analysis and making sure that the trend is monitored and there are controls in place to make sure that the terms and conditions can be enforceable. Thank you. We're going to see you on the next video.